Good evening. Please come to next paragraph number 3. Classification of mutual funds. So first few minutes we will discuss the classification of mutual fund. Mutual funds are classified on the basis of function, portfolio and ownership. So first we'll see functional classification. Under functional classification, all mutual funds will be divided into two categories: open-ended fund and closed-ended fund. Open-ended fund and closed-ended fund. Since you have studied SFM, what is open-ended fund? Anytime the mutual fund units can be bought and sold. Is there any maturity date in case of open-ended scheme? No. So that is the reason it is called open-ended. No maturity date. Investor can make entry and exit at any time. Now because of online trading, you can buy any time at night also. But you will get the units on the next day only. Okay. Also the capital of the fund is unlimited. There is no restriction on how much money they can raise. If more and more investor buy units, the unit capital will go up. Okay. If more and more investor buy, unit capital will go up. And if more and more investors sell, unit capital will come down. And the redemption period is not defined. Redemption period is indefinite. So these are called open-ended scheme. That means the scheme is continuously available for buying and selling. If scheme is continuously available for buying and selling, in India more than 80% of the mutual fund schemes belong to open-ended category. More than 80, or it may be around 85 to 90% of the scheme are open-ended category. You have to buy from the same mutual fund, you have to sell it to the same mutual fund. What is closed-ended scheme? In case of closed-ended scheme, first the mutual fund will issue the unit, okay, in a scheme called IPO or FPO, and then these units are listed on the stock exchange, and then you can trade in the stock exchange in those units. Second thing, there is a maturity date. There is a maturity date. It has a limited life. Underline. If they ask you to differentiate between open-ended and closed-ended scheme, this is the difference. Open-ended has unlimited life, but this closed-ended scheme has a limited life. Suppose 3 years. After 3 years, all the assets of that scheme will be liquidated. So they will raise the funds and it will be distributed proportionately to all the unit holders. But in the meantime, if you want to trade in that units, you can do it on the secondary market. Once issued by the mutual fund, you can't deal with that same mutual fund, but the liquidity is provided by stock market. Investor can make his exit from the scheme by selling in the stock market or at the expiry of the scheme or during repurchase period at his option. So normally, how do you exit from this unit? In case if you want to exit, you have to sell it in the stock market, okay, or wait till the expiry. When the scheme is over, the mutual fund will redeem your units, or during repurchase period at his option. So closed-ended scheme. Does closed-ended scheme provide liquidity? Yes. How? They are available for trading in the stock market. Open-ended scheme are always liquid because unless it is a ELSS scheme or a scheme which has a lock-in period, any time you can buy or sell. Now what is interval schemes? Interval scheme is something new. It is a cross between open-ended and a closed-ended scheme. So how does it work? These schemes are open for both purchase and redemption during pre-specified intervals. That means in open-ended it is open for purchase and sale on any day. Interval schemes are open for purchase and redemption only on pre-specified interval, which can be monthly, quarterly or annually. So they will say these are the dates on which mutual funds can be bought or sold. So on that day you can buy yourself from the mutual fund house. Whatever will be the NAV on that day, that NAV will be applicable for purchase and sale. Then your question will be, what is NAV? Net asset value. Group 1 SFM, net asset value, asset minus liabilities divided by number of units. Okay. Then your question can be, what is the difference between interval fund and closed-ended fund? So interval funds are not required to be listed on the stock exchange, because they give you the option to redeem after some days or months. So there is a liquidity, but you have to wait for that period. Suppose it is monthly redemption, then after 30 days you can get it redeemed. If it is a quarterly redemption, after 3 months you can redeem. So it is not compulsory to get it listed on the stock exchange, but closed-ended funds are listed on the stock exchange because it provides liquidity. Interval funds can make fresh issue of unit during the specified interval period. In case of closed-ended fund, the issue is made only at the beginning. Later on it is listed and then you can trade in that. But interval funds periodically can also make a fresh issue of units, of course at the prevailing NAV. In interval funds, maturity period is not defined. In closed-ended fund, maturity period is defined. Okay, so this is the classification based on function, open-ended and closed-ended mostly, and interval scheme, which is just a mixture, a combo of these two. Now next is portfolio classification. Mutual funds can be classified according to where do they invest. Where do they invest? Okay. So here for discussion purpose we have three types: equity fund, debt fund and special fund. Equity funds will primarily invest in the equity stocks. That means around 65% and above. How much? 65% and above is invested in equity or equity related instrument. Equity funds are of the following types. Growth fund. So now we'll discuss different types of equity funds. You will enjoy these paragraphs now. So if you come across a mutual fund scheme which has this heading, growth fund, then you can understand they are going to primarily invest in equity stocks. And it is useful for those investors who want to invest for a longer term. That means you should have the ability to park your money for a longer term. You should have the ability to take the risk also. Then in the long run, this will provide you a high capital appreciation. Okay, so good for people like you who have so much of money with you during your stipend, articleship period. Those lakhs of rupees which you have accumulated, it is the time to park in growth funds. Good for those people who can park their money for longer period, who can take risk. And similarly, another type of equity fund is called aggressive funds. Aggressive, as the name suggests, they are good for those people who are willing to take even higher risk. Because these funds, they invest in startup companies, IPOs, new companies, startup companies, speculative shares. Now, of course, in such cases, risk is high returns are also high, but risk and return both are high. If things go well, you'll earn a high return, but if the things go wrong, you can lose the value of your investment. Again, good for people like you, the risk takers. Yes or no? How do you know that you are big risk takers? See a course. Don't you think you have taken a big risk in your life? Today, if you would have tried for, suppose, cricket, you must have played 2-3 IPL matches by now. If you would have tried for some movie, you would have become superstar by now. And what you are doing, understand. Next is income fund. This seeks to maximize present income of investor by investing in safe stocks. So what this income funds do? They invest in equity but safe shares, not too much of risk involved. And plus they invest in stock which gives high dividend. That means they will identify which company has high dividend yield, which you can get from their track record. Okay, and therefore when you invest in such high dividend yield stock, you get a higher dividend income that can be used to pay to the investor. So this scheme is basically good for which kind of investor? Who are looking for regular income, current income. Not for the people who want a high capital appreciation, but those who want a regular income. Suppose you retire after 60 and you don't have a regular source of income and you have a lot of pension amount, okay, gratuity amount, PF amount. You park in this income fund and they will give you regular income. Next is balanced fund. As the name suggests, balanced funds invest in both the shares also and bonds also. But major portion would be shares. Major portion would be shares. Around 60-65% would be shares and then 35% would be bond. And this is a mixture of growth fund and income fund. They give you the advantage of capital appreciation also, and at the same time they give you income also. So good for those people who don't want to fall in either of the two extremes. You don't want to take a very high risk also, yes or no? And you also want a regular income. So that is why in India balanced funds are very popular, because then it serves both the purpose. Some capital appreciation also, some regular income also. So risk is more than income fund, but risk is less than growth or aggressive schemes. Okay. So that is about equity. Now what about bond funds or debt funds? Debt funds we will divide into two broad categories: bond funds, gilt funds. Bond funds means they invest in fixed income securities. That is, they would park majority of their money in those securities which give a fixed rate of return. Like for example, government bond, corporate debenture, convertible debenture, money market instrument. Bond funds are less volatile because they are investing in such instrument which themselves are less volatile. You don't find government bond prices increase by 30% on a given day, falls by 50%, no. And often produce regular income also. Advantage, they will keep paying you interest, so that you can use it for paying the dividend to your unit holders. For these reasons, investors use bond funds to diversify, provide a stream of income, or invest for intermediate term goals. Good for those people who wants to first diversify their portfolio. Do not put all your investment in equity. Some investment should go in debt also. So you can park in bond fund. Sometimes you have surplus money only for few months or few years, and you don't want to take risk with that money. So where will you park? Bond fund. Suppose after 6 months you want to go to Stanford University to pursue MBA, okay? You'll become CA. And you have parked all your money in aggressive fund. previous aggressive fund. After 6 months, the market has collapsed, your value of investment has gone down. So from Stanford University, you'll end up in Pune University. Okay. Savitri Bhai Phule Pune University. Your dream of becoming MBA will be shattered. From a chartered accountant, you will become a shattered accountant. Okay. So don't do that. Invest in bond fund. And be happy. Your money is safe. So that is the meaning of intermediate term goals. Corporates also receive a lot of surplus money. They receive order from their customer, advance demand drop. But this money they have to use for manufacturing purpose, production purpose. And therefore they will park this money for a few months in bond funds. So like stock funds, bond funds have less risk. Bond funds have risk and can make or lose money. I'll explain the last line on the screen. People may think that there is no risk in the bond fund. That is a myth. That is a myth. Why? Bond fund also have risk. Suppose tomorrow RBI governor increases the rate of interest. Bond prices will fall. NAV will fall. And therefore investor may suffer the loss. The only thing is that risk is relatively less. Risk is relatively less as compared to equity because it won't fall by such a high percentage. But yes, you can lose money in bond funds also. Same thing for gilt funds. Same discussion for gilt fund. So hence we have not spent too many lines on this. Only difference is gilt funds invest only in government securities. Bond funds can invest in government and private sector companies' debentures also, money market instrument also, and these are supposed to be safe instrument. Good for those people who don't want to take high risk. Okay. Now we'll discuss special funds. Special funds are of following types. Right here, following types, not just four, there are many, are of following types. So basically they are created for some specific objective. They also show the creativity and innovation in the field of mutual fund industry also. They can also help to meet certain targets of the investor also. Okay, like for example, index fund is a very good innovation. You are the article student, okay? I will draw your picture. This is a article student. Cap. Now, he earns 5,000 rupees stipend per month. And he wants to invest in all those 30 shares of BSE Sensex, okay? He wants to buy shares of Infosys. He wants to buy shares of TCS, Reliance Industries Limited, Tata Motors Limited, HUL, Maruti, Bajaj Auto, Larsen and Toubro, and so many. And he has 5,000 rupees. Okay, 30 shares. Even if we buy one of each of these 30 shares, how much amount he will require? About 2 lakh rupees. About, say, 2 lakh. Even if you buy just one share of each of them, you might require about 2 lakh rupees. How much he is earning? 5,000. His dream is shattered, from chartered to shattered accountant. Don't cry. You can invest in index fund. Many mutual fund houses offer you index fund scheme. What is index fund scheme? You invest this 5,000 in a mutual fund. Like you, there are thousands of other investors also. who also wants to enjoy the benefit of diversification, who wants to enjoy in the shares of an index, but they don't have money to buy all shares, so they can invest in index fund. 5,000, 10,000, 1 lakh. Mutual fund will have a corpus of say 100 crore rupees now, that they can invest in these 30 shares. So mutual fund will invest in 30 shares. You are investing in the units of mutual fund. So indirectly you are investing in those 30 shares. So as those 30 shares will perform, your NAV will accordingly appreciate or depreciate. Okay. So that is the innovation called index fund. So there are index fund which track Nifty. There are index fund which tracks Sensex and like this. So every stock market has a stock index. For example, BSE, Sensex, NSE, Nifty, Hong Kong Stock Exchange, Hang Seng, which measure the upward and downward movement of stock market. Index funds are low cost funds and influence the stock market. The investor will receive whatever the market delivers. These are called passive funds also. Why? Because the fund manager here can take little rest. He does not have to decide what he does not have to decide, which shares to buy. But he has to only decide how much to buy, when to sell. And he should try to outperform the market. If Sensex has delivered 20% return in a year, that fund manager is successful, efficient, if he has delivered more than 20%. Okay. Next type of special fund is called international fund. What is international fund? A mutual fund located in India to raise money in India for investing globally. Raise money in India. Okay. Located in India. And where do they invest? Outside India. So they will take money from you, invest in foreign country. So they are called international funds. Why such funds are allowed? See, for example, you want to purchase shares of Google, Facebook, Amazon, but you can't do it. They are not listed on the Indian Stock Exchange. Directly you can't purchase them. There are so much of complications involved. Remember, what you do, simply you identify an international fund, a mutual fund which invests outside India, who is allowed to invest outside India. So if you purchase the unit of this mutual fund which invests outside India, indirectly you are able to invest in the shares of a foreign company through international fund. Okay. What is offshore fund? This is opposite. Located in India. Raise money globally for investing in India. So they bring money from foreign investor into India. So NRIs want to invest in India. So what they can do? They can invest in this offshore funds and that money comes to India for Indian investment. That is called offshore fund. Next is special fund. Sector fund now. Under that, sector fund. Now these funds have a very special feature. They invest their entire fund in a particular industry. They invest the entire funds in a particular industry. Okay. Now there is an advantage and there is a disadvantage. What is the advantage? If that industry is expected to perform well in the coming years, you enjoy the benefit of that growth. But if that industry is not if does not perform well, then you lose a lot of money. If things go wrong, you can lose money. This sectoral fund does not give the benefit of diversification. One of the reasons why we invest in mutual fund, they give the benefit of diversification. If you cannot invest in 40 shares, they will invest in 40 shares. But if they invest all shares in a particular type of company, benefit of diversification is not there. That is one disadvantage. For example, in India we have some mutual fund houses which are specializing in certain industry only. Like for example, there is a utility fund. Example. The utility fund would invest in utility industries only, like power companies, gas company, or other public work company. There is a pharma fund also. Pharma fund. Where do they invest pharma fund? In pharmaceutical company. There are IT funds. They invest in information technology company. Okay. Then banking sector fund is also there. They invest only in banking sector companies like SBI, ICICI, HDFC and like this. Next special fund is money market funds. As you know, money market means, we have done this chapter, investment in long term or short term security. Investment in short term securities. So they basically, as the name suggests, they invest in money market instrument. Money market instruments are debt instruments, because the maturity period of such instrument is very, very small. The maturity period ranges from few days to 1 year. So are these risky investment or safe investment? Safe investment. Do they provide you liquidity or are these illiquid investment? Liquidity. In fact, in case of money market mutual funds, you can convert into cash in 1 or 2 days itself. Within 1 or 2 days, you will be able to convert into cash. To achieve this objective, liquid funds invest predominantly in safe and short-term instrument. Example, where do they park their money? So if you are investing in money market fund, remember, your money will be invested in commercial paper, certificate of deposit, treasury bill, government securities. Good for those type of investor who have temporary surplus, like corporates. Okay. So for example, Maruti Suzuki receives 100 car order from their dealer. The dealer says, we want 100 cars. This is the demand draft, 30 crore rupees. Please send us 100 car. Example. Now you don't require 30 crore rupees immediately. You will spend it over next 1 month in manufacturing cars. So till that time, what will you do? Park it in the money market fund and you will get some return. Whatever returns this commercial paper, certificate of deposit generate, mutual fund will earn and mutual fund will pass it on to you after deducting their expenses. Okay. This is highly popular scheme because normally there is no fluctuation in the value of investment. Why no fluctuation in the value of investment? Because they're short-term instrument. Even if the market interest rate change, if the maturity period itself is 6 months or 9 months, the change in interest rate will not affect the value of the investment much. Okay. See, the present value formula is future value upon 1 plus r to the power n. But if this n is so small that even if the r changes but the n is so small, the value does not get affected much. Is it right? The value will get affected much if the n is high. Second, these are issued by government, banks and reputed corporate houses. Commercial papers are issued by highly rated corporate houses. These are regulated by RBI. Only if you can meet those norms, you can issue commercial paper. Certificate of deposit is issued by bank. Only if you can meet the RBI norms, you can issue certificate of deposit. This we have covered entire instrument in which chapter? Money market. Do you remember such chapter existed in your syllabus? One more interesting thing about this. Suppose you are an article student. You want to buy commercial paper. Minimum investment is 25 lakh. But you say, I have only 10,000 rupees, 15,000 rupees. Some of the articles are so poor they don't have 3,000 rupees also a month. But they want to enjoy the benefit of commercial paper. Invest in money market mutual fund. You invest in money market mutual fund, like you, another 40,000 articles will invest, and this mutual fund will have a huge corpus. Right. Index fund we have discussed. Why it has come again, Nalayak. Next is fund of funds. Fund of funds. What is fund of funds? You are the investor. Okay, this is the investor. And there are now more than 1,000 mutual fund schemes. These are mutual fund schemes. He is the investor. He is thinking, where should I invest? Should I invest in this Reliance mutual fund, HDFC mutual fund, Kotak mutual fund, ICICI mutual fund, DSP BlackRock? Where should I invest? And not only that, Reliance mutual fund has got 40 different schemes. Example, they have more. HDFC has got another 40 different schemes. So 40 mutual fund houses. Each of them has 30 to 40 different schemes. Multiply 40 square. 1600? Confused. He says, same problem in the stock market. I came from a stock market so that I don't have to take the decision where to invest. And now the same problem is in mutual fund. So now there are few funds of fund scheme. You invest in fund of fund. And then they will decide where to invest. In simple word, this fund of fund is a mutual fund scheme which invests in another mutual fund scheme, so that the investor is saved from the trouble of deciding in which mutual fund he wants to invest. Okay. They can invest in another scheme also. So this fund of fund is suppose floated by Kotak. This can invest in HDFC mutual fund. They can. So fund of fund, as the name suggests, are scheme which invest in other mutual fund schemes. So this is a mutual fund scheme which invests in another mutual fund scheme. The concept is popular in market where there are number of mutual fund offerings. As I said, now in India, the solution has become the problem. Solution was, if you don't want to invest in the stock market, go to mutual fund. But the problem is, which mutual fund? The number of mutual funds now available is more than number of shares that are available. So you have to just choose a suitable fund of fund. They will decide in mutual fund. So imagine what will happen after 20 years. There will be 100 fund of funds. Each mutual fund house will give you 3-4 fund of fund scheme. And now the investor will think which fund of funds. So then somebody may come out with fund of fund of fund. Okay. So that fund of fund of fund will invest in fund of fund. They will invest in mutual fund. and after 80 years you can imagine yourself. Okay. Just as mutual fund scheme invest in portfolio of securities such as equity, debt, the underlying investment for a fund of fund is the unit or other mutual fund scheme, either from the same fund family or from other fund houses. So your question was, do they invest in the same fund family or other fund houses? So they can invest either in their own schemes. Suppose it is a Kotak fund of fund. So other schemes of Kotak mutual fund, but they can invest in HDFC or ICICI or Reliance or whatever. Now, capital protection oriented fund. Capital protection oriented fund. So what is their objective? Protection of capital. As the name suggests, they would be prima facie investing in such shares, such investment where the risk would be less. The risk would be less because their objective is to protect the capital of the investor. Understood? Their objective will be to protect the capital of the investor through suitable orientation of its portfolio structure. The orientation towards protection of capital originates from the portfolio structure of the scheme and not from any bank guarantee, insurance cover, etc. So how do they give such kind of protection? Do they take any bank guarantee? No. Do they take any insurance? No. It is all because they invest in such stock, such investment that the risk is less. So this was also popular with the investor because investors don't want to lose their hard-earned money. Is it right? They want, if I don't earn anything, at least my capital should be prevented, protected. SEBI stipulation required that this type of scheme to be closed-ended in nature. So if you want to launch such scheme, they have to be closed-ended in nature, listed on the stock exchange, and the intended portfolio structure would have to be mandatorily rated by a credit rating agency. Then you can launch such scheme. Closed-ended, listed, credit rating. Now, what will be the usual structure of such mutual fund? A major portion of the asset would be for capital safety and could be invested in a highly rated debt instrument. Of course, if you want to protect your capital, you have to park most of your money in highly rated debt instrument. If you park most of your money in equity or equity related instrument, then there can be loss. You will not be able to offer capital protection. So some portion they will park in equity, but majority of the amount is parked in the highly rated debt instrument. Capital protection schemes are a recent entrant in the Indian capital market and should not be confused with any capital guaranteed schemes. Capital protection oriented funds are different category of mutual fund. They are not capital guarantee scheme. Now next is gold funds. So these are basically exchange traded funds. What is exchange traded fund? Suppose you are an investor, you love to invest in gold, you want to buy gold. 1 kg gold you want to buy. But then there is a problem. You have to store it. Risk is there. Somebody can steal it. So you want to enjoy the benefit of gold without physically holding the gold. How you should do it? Very simple. You can now invest in gold funds. You can invest in gold funds. They invest in gold. You have to invest in the units of gold fund. Yes. Very popular scheme now. Government has also launched so many schemes. Yes. Recently government had come out with one gold bond also. Sovereign gold bond. Where you can invest in the bond and that money will be used to purchase gold, and then you get the return accordingly as the gold prices would change, right? So this is the gold fund. As in India, people are obsessed with this item called gold. Okay. The objective of this fund is to track the performance of the gold. So those who think that gold prices are going to rise, but he does not want to directly purchase gold, welcome. Purchase gold fund or gold ETF. The unit represents the value of gold or gold related instrument held in the scheme. So the value of your NAV will depend on the gold values. So as the gold price will go up, NAV will go up. As the gold prices will fall, NAV will fall. So it is linked to gold value. So gold funds are generally traded in the form of exchange traded fund. We will discuss this somewhere below exchange traded fund. That means a mutual fund which is traded on a stock exchange like any other stock. What is an exchange traded fund? Name itself, a mutual fund, a fund which is traded on the exchange. And these ETFs generally track the performance of an index or a commodity or a currency. Is it right? So if you can't invest in Nifty, Sensex, there are Nifty ETF. If you can't purchase gold, then you can invest in gold ETF. So they track the performance of index, commodity. They are traded on the exchange and you can buy and sell them like a normal stock from the stock exchange. Are listed on the stock exchange and offers investor an opportunity to participate in the bullion market. Bullion means gold and silver, precious metal market, without having to take physical delivery of gold. Okay. So instead of gifting your daughter as gold in the marriage, you should give them gold ETF. Instead of asking gold in the dowry, you can ask for gold ETF, but dowry is bad. Okay. Yes, I'm telling you. Gold ETF, ask. They will also be surprised that my son-in-law is smart. Now, next point. Ownership classification. Now, in your book, there is a diagram drawn which is not appearing on the screen. How the risk changes from one type of mutual fund to another type of mutual fund. Suppose the institute says arrange the following mutual fund in the order of risk, starting from the lowest risk and going towards the highest risk. So the lowest risk and return is money market mutual fund. Then short and intermediate term bond funds, long term bond fund, balance fund, growth and income fund, then only growth stock fund, and at the other extreme is aggressive growth stock funds. So according to your risk taking ability, the investor would invest in one of these bonds. Next paragraph. Classification of mutual fund according to the ownership. That means who is the sponsor? Who is the sponsor? Main promoter. In this chapter, the promoter is called sponsor. Okay, company form of organization we call promoter. In case of trust, we call him sponsor. So who is the sponsor decides the classification. For example, in India we have three types of mutual fund. Public sector mutual fund, where the funds is sponsored by a company in the public sector. The best example, as you know, is UTI, SBI mutual fund, okay, LIC mutual fund, Can Bank mutual fund, all this IDBI mutual fund. Private sector mutual fund, the sponsor is the company in the private sector. Like there are many. HDFC Mutual Fund, ICICI Mutual Fund, Reliance Mutual Fund, Tata Mutual Fund, Birla Mutual Fund, etc. Homework, write 5 more names. Foreign sector mutual funds, the sponsor is a foreign company. Sponsor is a foreign company, are sponsored by companies for raising funds in India, operate from India, and invest in India. So these are, sponsor is foreign companies, right? Sponsor is foreign company. As you know, yesterday you have seen the growth of mutual funds in India. Foreign mutual funds like DSP, BlackRock, okay, then Franklin Templeton, these are some of the big mutual fund houses. Fidelity, okay, these are foreign mutual funds. They operate in India, raise in India, invest in India. Whatever you want to do, India. Don't take money out of India. Now one important discussion is types of schemes. Types of schemes. Because when you are investing in mutual fund, you should understand what is the scheme. Scheme means basically where your money would be invested. In which kind of security your money would be invested, what is the risk involved, and according to your risk taking ability you would decide to invest in those schemes. Okay, so since you are a CA student and tomorrow you'll become CA, you have to invest your own money and you have to also ask your client to invest. So therefore a good understanding of mutual fund will help you in your own personal life and in professional life also. And you can also help Virat Kohli in future to help him to park his money. Okay. Ranveer Singh also. Now come to next, balanced fund. Did we come across balanced fund some minutes ago? When? In the discussion on equity fund, there are 4 types we discussed. So balanced funds means such funds strategically allocate the money in both equity and debt. Equity and debt. Why? There are people who don't want to take very high risk. They say, no, we will not invest in equity share. There are people who say, no, we don't want to invest in debt securities, debt fund. There's no return. What is the point? No, you don't want equity also, you don't want debt also, but you want the benefit of both. Balance fund. Okay. So this balance fund invest in equity around 60 to 65% and around 40 to 35% they invest in debt fund. So good for those people who want to take a moderate risk, neither very high risk nor very low risk. Balance funds are very popular in India because most people are this category. They don't belong to the extremes. They want some return also, high return, but they don't want too much of risk also. So which scheme you will suggest for such people? Balance fund. Anybody who asks me where should I invest? Personal information. I say invest in balance fund so that later on I should not be in trouble. Okay. So if somebody asks you, your neighbor, your relative, your friend, where should we invest? You simply suggest him some balance fund. Okay. So he will neither gain too much nor he would lose also too much. So he will be happy. 4.2 Equity diversified funds. Now mutual fund industry has lot of innovations in the last few years. After these private sectors have come, they are coming out with new types of product. Ultimately in the market, if you bring new product, then again you can capture new investors. You can make the investors shift from other scheme to your schemes. So they are coming out with a lot of innovative ideas, innovative products. So what is a diversified fund? As you can guess from the name, diversified fund. It means they invest in a large number of stocks. They invest in large number of stock. The idea is to offer you a high level of diversification. Investor wants high level of diversification. Why does investor want high level of diversification? Because he wants to reduce the risk. Since the market is very volatile, as you know, stock market is going to remain volatile for the rest of your life. If you invest in multiple securities, risk is diversified. So some of the popular diversified funds we will discuss. Flexi cap or multi cap fund. Flexi cap, multi cap fund. That means they will invest in a large number of big companies. Multi cap, different, big, small, medium also. Multi cap means they will invest in mid cap company also, large cap company also, small cap company also. Multi cap. So on one hand they are going to invest in TCS also. On the other hand, they will invest in some small company also, whose turnover may be 100 crore. They will invest in Reliance also, turnover may be in lakhs of crores of rupees. The only difference is, unlike a normal diversified fund, the offer document of a multi-cap flexi fund generally spells out the limit for minimum and maximum exposure to each of the market caps. So what they will say, that our exposure in large cap, mid cap and small cap fund. Then you will wonder, what are the small cap, mid cap and large cap companies? This we'll discuss later. SEBI has recently defined the meaning of large cap, mid cap and small cap companies. So I will discuss it later. So they have to say that we are going to invest as follows. That is, they have to make it clear in their offer document. That is, what will be their exposure to each type of funds. Okay, large cap means big companies, mid cap, not very big, not very small, and small companies. Okay. And then some mutual funds in India, they have come out with this contra fund. Okay, contra, they go against the wind. A contra fund invests in those out of favor companies. Which company? Out of favor, that have unrecognized values. Now they search for companies which are undervalued. They search for companies which are undervalued because they think that if I can pick this undervalued firm right now, and if it reaches its actual potential, will make a huge profit. So contra, going against the norm. It is suited for investor who wants to invest in a fund that has the potential to perform in all types of market environment, as it blends together both growth and value opportunities. But for you, that you have to take a risk. Okay. Investors who invest in contra funds should have an appetite for high risk, because you are going against the tide. Okay. So if some sector is performing, they may not invest in that sector, but they might invest in another sector, which their fund manager think has a potential which is yet to be realized. Now this is another popular scheme called dividend yield fund. So where do they invest? They invest in companies which have high dividend yield. They invest in companies which have high dividend yield. What is the meaning of dividend yield? In your SFM or in your FM you have studied. Dividend yield means DPS upon DPS upon MPS. DPS upon MPS. In fact, in order to decide where to invest, this is a very good ratio. If you talk to many investors, good investors, one of the ratios which they check to invest in a company is dividend yield. That is, this is the market price, this is what I actually get in cash. Capital appreciation is separate, but at least this portion I am getting back in dividend. So which company has high dividend yield ratio? Those which are really strong company, good companies, cash rich companies, cash profit generating companies. Okay. Most of these funds stock in companies having a dividend yield higher than the dividend yield of a particular index like Sensex or Nifty. So in a year we will see what is the average dividend yield of Sensex companies, what is the average dividend yield of Nifty companies, and we will invest in those companies which gives us a dividend yield higher than Sensex or Nifty companies. So 30 companies of Sensex, calculate their average dividend yield, say 10%. Then identify in the market which companies have given you more than 10% dividend yield. Better invest in those companies. Such companies' share prices are less volatile also than growth stocks. Dividend yield funds are less volatile than growth funds. Besides, they also have the potential to appreciate. So among diversified equity funds, dividend yield funds are considered to be a medium risk proposition. Again, if you have to suggest somebody, this is a good scheme, dividend yield fund. Okay. Dividend yield schemes are of two types. Which two types? You have studied in SFM, dividend payout option and dividend reinvestment option. What is a dividend payout option? Suppose you tick dividend payout option. Two options they will give you in that form. Okay, or nowadays on the scheme name itself it is written, do you want growth, do you want dividend, do you want reinvestment? So if you tick mark dividend option, then whenever the mutual fund will declare dividend, they will calculate your share of dividend and transfer the dividend in your bank account. Okay, transfer the dividend in your bank account, online transfer, unless you want the dividend check. Okay. So what is the advantage of dividend payout option? You get regular cash. Good for those people who have retired, for example, who do not have enough regular income. So they can invest in this dividend payout option scheme. Monthly or quarterly or half yearly, they will pay the dividend and you can enjoy life. But people like you who already earn so much money, you don't depend on dividend income. So you have enough salary, enough stipend, you can enjoy life right now. Which option you can tick mark? Dividend reinvestment option. Tick dividend reinvestment option. So now what will happen? The dividend which the company will give you will actually be converted into units. At what rate? At X dividend NAV. At X dividend NAV. And the number of units held by the investor will increase. Number of units held by the investor will increase. So when he will redeem, he will get more money, because suppose he purchased 10,000 units, 2,000 units were reinvested, so he can sell now 12,000 units. Okay. Whether a person should take dividend payout option or dividend reinvestment option or growth option, that depends on his individual situation. So first check whether you need regular income, can you take a risk, what is your tax status, what is your family background, how many people are there in the family, when do you need money. Considering all these factors, one should tick mark dividend reinvestment or growth option. Okay. Growth means they don't pay dividend. Only the NAV will keep on increasing. Whatever the scheme earns, it is again used by the fund manager for more investment. in dividend reinvestment scheme, first they calculate dividend and it is converted into units. So their reserve will go down, units will increase. In growth option, the reserve will only increase. Effect is the same. Effect is the same. Okay. But growth scheme is better because then tax saving is there. Unnecessary, one of the two will end up paying the dividend distribution tax if you declare the dividend. Okay. So dividend reinvestment scheme is not very popular to my understanding. It's better you go for growth only, na. Even if mutual fund pays dividend distribution tax, ultimately it will reduce the NAV of the scheme. So investor would indirectly suffer. Now one of the very popular schemes with the CAs, chartered accountant, who suggest their client is ELSS, equity linked tax saving scheme. Yes or no? Under which section of Income Tax Act you get deduction? 80C. How much? Up to 1 lakh. 1,50,000. Not 1,60,000. Then what is that 1,60,000 for? Or 150? Okay, as on now, as on the day when we are discussing it, is 1.5 lakh. Okay, you can check it when you go to the exam. Government keeps on changing these limits. It was 1 lakh some years ago. Before that it was some 80,000 or something also. So depending upon when the election is there, how far or how close you are to the election, the limits can change. Okay. So please check the income tax for the limit, which at present is 1,50,000. And there is a drawback of the scheme. You have a lock-in period of 3 years. But there is an advantage also. You get deduction under the Income Tax Act. Suppose your income is, let's say, 6 lakh rupees. You invest 1,50,000 in this ELSS scheme. Your taxable income immediately reduces to 4,50,000. So earlier you would have paid a tax of how much? 6 lakh is the income. How much tax you will pay? I don't know. 30%? No. I think that first 2,50,000 is 0. Then 5%. So 2,50,000 into 5%, 25,000, 25,000. No. 2,50,000 into 5%, 12,500, and then 10%, 20. So 20% of 1 lakh, 20,000. So you would have paid 32,500. So instead of paying 32,500 here, you will just pay 2 lakh into 5%, 10,000. Yes or no? And if a person who belongs to high tax bracket, you will save 45,000 rupees. If you belong to say high tax bracket, 30% like you, so you can save 45,000 rupees in a year. So that's a tremendous saving. And plus the lock-in period is also just 3 years. If you invest in other 80C investment item, the lock-in period is minimum 5 years other than this product. Am I right? Like for example, PPF and National Saving Certificate, National Pension Scheme, NSC, 5 years, but this is only 3 years. And plus it is giving you the benefit of equity growth. Okay. I have done the analysis in last so many years. It is the best product under 80C. It is the best product under 80C because lock-in is 3 and returns are higher than any other product that you get under 80C. What more do you want? Is it right? So this you have to tell your friends. I have told even my consultant, he was telling me you buy this. I said no, you buy this ALSS, you will earn more. And then now he has also changed his strategy. Why to invest in that insurance product and this PF 7-8% government return? On that you sometimes pay income interest also. On interest you pay the tax also. Is it right? No. On NSC interest you have to pay tax. Yes or no? Yes, you have to. You can check. NSC interest is taxable. But here you don't have to pay. Moreover, by investing in ALSS through a systematic investment plan, SIP, systematic investment plan means periodic investment in a mutual fund scheme. It promotes saving habit among the investor. About SIP we will discuss a little later. Okay. It means periodic investment. So you can opt for 1 year SIP. So 12 times you have to pay a particular amount. Okay. You can stop also the SIP in between. You can extend it also. Lot of flexibility is there just to bring more and more investor into the mutual fund schemes and help them promote regular habit. One can not only avoid the problem of investing a lump sum amount towards their end, but also take the advantage of averaging. Averaging means if you invest at different points of time, you get the benefit of average cost. Sometime you may end up buying at a high NAV, but sometime you end up buying at a lower NAV also. And therefore you get the benefit of averaging. And you don't have to invest huge amount at one go. You can invest small amounts. Good for salaried people who can't take the benefit in one installment. Then you should give an instruction to the mutual fund. You deduct 4,000 rupees every month. Okay. You deposit 4,000 rupees in SIP every month. So that is ELSS scheme. They invest in equity. Equity linked. Equity. If you see the name, they will help you to understand. So they are basically tax saving scheme which are linked to equity. How is the return? Very high. I have told you. They give better return than any traditional tax saving instrument. Mark my words, this is the best scheme in all the 80C category, and it is the best mutual fund scheme also. It is the best of the lot. If a company offers 40 schemes, you select their popular ELSS scheme. 1 or 2 schemes are ELSS in any mutual fund house. And this is the best, but only limitation for 3 years you cannot withdraw the funds. If you can wait for 3 years, then this is the best of the best lot. Okay. Then next is your sector fund. This we have covered. So I will skip it. Okay. They invest in a particular sector shares only. So I have covered that. Now come to 4.5 thematic funds. What is thematic fund? They invest according to certain theme. Like it is believed that in India, infrastructure will grow at a very rapid pace. Along with infrastructure, housing will grow. So what they will do, so their theme is that in the next few years, in India, infrastructure and housing is a growing sector. So they would invest mostly in companies which belong to infrastructure and housing. Now they will also invest in those banks which give loan for housing also. If housing sector is growing, means banks will also grow, right? So that is thematic fund. So they identify few sector which according to them is going to grow and they invest there. So if their theme works out to be true, they'll make huge amount of profit. But sometime it can go wrong and you might suffer the loss. So few mutual fund houses have these thematic funds also. One mutual fund had come out with some years ago. a scheme called Tiger Fund. What is Tiger? So each of these letters stand for some particular sector. Like T stands for, say for example, telecom. I stands for infrastructure or IT companies. I'm not very sure. Then again G for some government or growth company. E for energy or education, something like this. And R for, let's say, real estate or something. So this was their theme, that in the next few years India will have a growth in these 5 sectors. So Tiger Fund. Okay. So a thematic fund focuses on trends that are likely to result in the outperformance by certain sector or companies. So they are betting on certain sectors. In other words, the key factors are those that can make a difference to business profitability and market values. So they do lot of research. They take the research report of lot of research houses, and then they see where we are going to head for next 5 to 10 years. So however, the downside is that the market may take a longer time to recognize the views of the fund house. Fund house is in a hurry. Yes or no? Market is not in a hurry. So market may not respond the way you are thinking with regard to a particular theme or a particular time frame, and which form the basis of launching a fund. It is said that the reformer is in a hurry. Gandhiji is in a hurry. People of India are not in a hurry. So thematic funds are in a hurry. They want that growth will take place. We are not in a hurry in India for anything. Okay, only when crossing the road we are in a hurry. Only for breaking the signal we are in a hurry. That is where all our efforts lie. What are arbitrage funds? These are also getting popular nowadays. Now, we are going to solve a question soon. Hold your breath. We will give you a scheme detail, and after reading the scheme detail, you have to identify whether it is equity fund, bond fund, debt fund, sector fund, or thematic fund, or arbitrage fund, or diversified fund. Okay, small cap fund, mid cap fund. If you see the next page, you will have a little heartbreak or heart attack kind of situation. Okay, page number 13 of this chapter. Dream when you focus 25 fund regular plan. Can you see that? And then they've given the story of that fund. What do they do? And after reading that, your institute has actually asked this question. Classify the mutual fund scheme. Okay, so what I am telling you, have to listen to me carefully. It's not that you listen to me and it is over. They will give you a reverse question. They will say a mutual fund scheme has following characteristics. You have to identify the scheme. Right answer 2 marks, wrong answer not -2, just 0. So now let us see what is arbitrage funds. You are a student of SFM. This word arbitrage means you invest in different markets, buy in some, sell in some. That is arbitrage. You try to benefit from price differences. You want to ensure that if there is a loss in one, it will be compensated by the gain in another. So therefore these funds, they invest in various types of financial products. Like for example, they invest in equity also, equity related derivative, future and option also, and debt market also. This open-ended equity scheme aims to generate low volatility returns by investing in a mix of cash, equity, equity derivative and debt market. So they invest in multiple products, not only equity and debt, but they also invest in the derivative. The idea is to reduce the volatility. The fund seeks to provide better returns than typical debt instrument. Why these are getting popular? Returns are more than a usual debt fund, and volatility is less than the equity fund. Returns are more than debt fund and volatility is less than equity fund. Typically, these funds promise safety of deposit, but better returns, tax benefit and greater liquidity. Okay, so you will say, why can't we invest in bank FD only? You can, but arbitrage funds will give you more return than a comparable bank FD government security, and it also gives you liquidity. Anytime you can sell. Then there is a company called Pru ICICI is the latest to join the list with its equity and derivative fund. You can just go to some website like moneycontrol.com and you can just type any particular funds that you want to know and you will get it. Is it right? So they will give you a complete detail of such funds. As a student of this subject, some research you should do. Okay, where will you do? Either go to AMFI's website, AMFI, Association of Mutual Fund of India, or Money Control. There is a website which gives a lot of information about share and mutual fund, etc. Okay, so do that. Find out few companies which have this scheme. One example is Pru ICICI. This fund is aimed at an investor. Good for which investor? He wants a benefit of small saving instrument also, less risk. He wants the safety of a bank deposit also. He wants the tax benefit of RBI relief bond also. And he wants the liquidity of a mutual fund. Okay. So you want Katrina also, Deepika also, Anushka also, and Alia also. All in one. Arbitrage fund. Is it right? Don't write that. That means you want benefit of all the world. Now arbitrage fund seeks to capitalize on the price differential between the spot and the future market. So they take position in derivatives also. Now the next is cash fund. Cash fund is an open-ended liquid scheme. It is like your money market mutual fund only. They are very liquid. Where will they invest? Yes, equity or debt? Name. They would invest mostly in debt market and money market instrument. Okay. Risk is less, return is less. Good for those people who have surplus. Good for retail investor, institutional investor or super institutional plan. Each plan will offer growth and dividend option. That means you can choose growth or you can choose dividend. Growth means no dividend, appreciation in the NAV. Because the fund manager will keep on using the same money for more investment purpose. Now what is the minimum investment for institutional plan? 1 crore. Okay. And super institutional plan 25 crore. But for you, the retail investor, you can start with rupees 5,000. Only 1 month stipend. Only. Such funds usually don't charge you entry load or exit load. They charge only that asset management fees. Entry load means when you buy the mutual fund, you don't have to pay anything over and above the NAV. Exit load means when you sell the mutual fund, you don't have to pay anything. You will get exactly at the NAV, the amount in your account. Okay, investors can invest even through systematic investment plan SIP route with a minimum amount of 500 rupees per installment with the total of all investment not being less than rupees 5,000. So you can go for SIP also, systematic investment plan, which means it's like a regular investment. Minimum is 500 per time you have to invest and at least you have to invest rupees 5,000. More than that is welcome. Now the last scheme we will discuss. already discussed a little bit, little more. Exchange traded fund. Exchange traded fund. So like you want to invest in Nifty, Sensex, but these are not something which you can buy. Can you buy Nifty? Can you buy Sensex? You can't buy Nifty. You can't buy Sensex. These are not stocks, these are index. You want to benefit from the appreciation of Nifty or Sensex. So what this exchange traded fund does, they invest in the stocks of Nifty. They invest in the stocks of Sensex or whatever index they are tracing, okay, checking. You invest in this mutual fund and they will invest in those shares which form part of the particular index like Sensex or Nifty. Then you will say it is similar to index fund. Yes, but there is a difference. Index fund is not traded on the exchange, but exchange traded fund is a type of index fund which is traded on the exchange like any stock. So you can buy and sell anytime from the stock market. Is it right? So that is why I say it is a hybrid product. It has the features of an index fund and it is a feature of a stock also. So every day they are traded on the stock exchange. Just like share price moves up and down, the value of this ETF also will move up and down during the day, and at the ongoing market rate during the day you can buy them. When you buy mutual fund, they sell that mutual fund to you at the closing NAV. That is once the NAV of that day is calculated, at that rate the units are transferred to you. But in case of ETF, you can purchase at the ongoing market rate, which is normally closer to NAV only. It can't be away from the NAV. Can it be away from NAV? No, it can't be, because it is the same thing. It is the same mutual fund which is traded in the market. Okay. So therefore the market value of this exchange traded fund is closer to NAV only. But it is very good instrument because you get the benefit of investing in different securities and it is available for trading in the market. So it is a very good innovation in the field of finance. Now there are exchange traded fund which track commodities like gold also, which we discussed some time back. Okay. They track other commodities also. They track currencies also. These funds are listed on the stock exchange and their prices are linked to the underlying index. ETFs can be bought and sold like any other stock on the exchange. ETFs can be bought or sold on any time during the market hours at the price which are expected to be closer to the NAV at the end of the day. Right. That means the market price is close to NAV. One can invest at real time prices. Now what is the benefit? Suppose you buy at 3 o'clock. You will get the value at 3 o'clock. If you buy at 10 o'clock, you will get the value at 10 o'clock. As against the end of the day prices, as is the case with open-ended scheme. Index fund is an open-ended scheme, but ETF is an index fund trading in the stock market. Okay, there is no paperwork involved for investing in an ETF. This can be bought like any other stock by just placing an order with the broker. ETF may be attractive as investment because their low cost, tax efficiency and stock like feature. So it has the benefit of mutual fund also, stock also. That is why index these are popular. You get the better of both the worlds here, mutual fund and stock. So last paragraph for the day. An ETF combines the valuation feature of the mutual fund or unit investment trust, which can be bought or sold at the end of each trading day for its net asset value, with the tradability feature of a closed-ended fund which trades throughout the trading day at prices that may be more or less than its net asset value. It gives you the benefit of mutual fund and stock. Okay. Now we will continue tomorrow.